So welcome to our demo lecture and introduction to kayak. We are focused on level 2 today, but we'll do a little bit on level 1 as well. First about me, I'm Thomas. I'll be teaching both level 1 and 2. Background, I was in accounting, and then I was focusing on iBank. I worked for an iBank for about a decade before I retired and teach at various places. I also focus on accounting before my finance life, so I have CPA from various places as well as I moved around for my job earlier. So for kayak, if you look at AI, it has gone mainstream in the recent decade. So now many investors can buy alternative investments. If you look at the buy side, now we have many big buyers, which if you look at 10 years ago cannot buy. So for example, many pension funds can now buy hedge fund as a part of their allocation. Many retail investors can buy as well, in particular in Asia. And so doing AI and kayak the destination will really help you understand what is being bought and help customers or in your job prospects. So this is a summary from a survey from the members. So here most found very useful in terms of career, knowing more about what others are doing. Practical wise is also very useful as well. There's many good job leads from networking with other members, and education wise is very good as well for future prospects. In terms of the topics, I'll do a quick level 1. For level 1, you see pretty similar asset allocation. So we have 4 main types of asset class. So we have, in our case, we have private equity as one major asset class. So that would include our venture cap and LBO. We have real asset. So this would include real estate, timberland, etc. Plus there's some commodities as well. So that would include trading of futures and forward contracts on commodities. Commodities here is a separate category for level 2, but it's combined with real asset in level 1. This will be on trading of commodities, futures contracts on various interest rates, currency, or real asset commodities. We have a big section on hedge fund and managed futures. So in level 1, you see these and structured products. In level 1, you see a pretty broad-based coverage of all these 4 or 5 asset class. So level 1 is a very broad-based introduction to the different styles, the risk of each asset, and who are the investors. For level 2, we have much more focus on particular types under each asset class. So for example, for private equity, there'll be a focus on the fees being calculated. Level 2 was just been revamped for March 2017, so you see a lot more additional information on private equity for level 2, which are just added. For hedge funds, we have convertible bonds, and that is the major part for level 2. In-depth calculation of your valuation for convertible bonds using binomial tree models, plus how to hedge away all the risk, so you're left with only the price discrepancies on the convertible bond itself as a arbitrage profit. For both level 1 and 2, we have professional standards. For level 2, it will be confirmed only in the essay question. So you have 3 essay questions for your level 2. One is on professional standards for sure. Second is on the current topics. This is a particular category for level 2, where you have a second book with about 10 to 15 latest research studies on AI returns and their structure. So another essay question on that. The third essay question can be on any one of these topics, or a cross-topic, cross-asset comparison on the third essay question. So it narrows down the scope of what can be covered for the essay type. In terms of the structure, it's similar to level 1. You have 2 sessions, multiple choice for the first part, similar 100 questions for the 3 hours. For the second section, instead of multiple choice, you have these 3 essay questions we have. So if you look at the timing, it's actually not too bad because you should have plenty of time to answer the 3 essay questions. These are the brand new things for the revamp for March 2007. There are over 14 new readings or updated topic areas. So some of those are in this current and integrated topic. Normally they update several articles each time, but here they're upgrading quite a few for March 2017. Many things are added as well for the other regular asset class. So family office and sovereign wealth funds are brand new to the curriculum. We have new things, additional things for infrastructure. There were a little bit before, but now they expanded the coverage for structured products as well. Now they have 2 major new sections which are outlined here. One is on fixed income derivatives, the other is on asset-backed and insurance-linked. So these are pretty new. Before that's still there, but it's very limited in scope. The other new things are private equity. So they expanded a little bit on, other than in addition to fees, who is buying them and the risk when you look at portfolio companies in the LBO or the VC structure. So these are the brand new things. Based on the reading and the underlying content, they estimate about 75–80% are brand new. Some are old topics, but they need to add new things to it. So it's pretty major revamped for level 2. In terms of study time, it builds on your level 1. So if your level 1 has studied quite a bit, the study time should be less for level 2, but still a lot of new readings and new in-depth area to cover in level 2. Here for level 1 and 2 as well, you have mainly quantitative and qualitative questions. For quantitative ones, you will see 2 different style of questions being asked, either in multiple choice or essay, but most likely quantitative will be more likely in the multiple choice part for level 2. So here you have the quantitative calculations. Normally they are of 2 different types. Let me jump past that. So for the calculation questions, this is a few slides down, page slide 13. Either they ask typical but mechanical type of quantitative questions. So you might be given a short paragraph of information from different perspective, and then you have several multiple choice questions based on that particular information paragraph. So example might be your private equity fee calculation or the return calculation for private equity. The other might be using binomial tree to calculate detailed bond price, the bond gamma and other Greek calculation, etc. So it can be asked one way like this, or for the quantitative question, it's not calculation, but it's theoretical. So they might ask a very simple short question on things on binomial tree, which if you understand how the formula works, it'll be pretty easy to answer, because multiple choice would have either plus or negative, so you can narrow down the answer pretty quickly and easily if you know what the underlying theory are. But if you don't, that'll be pretty difficult. So it's same goal for level 1 and 2 for the quantitative questions being asked. So now let me go back to the exam fees. So for level 2, you don't need to pay for the program enrollment, but you need to do for level 1. So if you pay for level 1, then you only pay for the exam registration fee. I think we passed the early bird, but you're saving $100, so it's still worth doing it. And the exam date will be for level 2, the second half of March. If you've taken level 1, all the arrangements are the same. You register with the CAIA, and then they set you a password to log into Pearson VUE to make appointment for the exam time slot. For level 2, this is a pass rate, so you see a gradual increase in trend. March 16 is 70%. I think September 16, we haven't updated this, but it's a high 60s as well. For level 1, it's about the same, 60-ish, mid to high 60% pass rate. So generally, it's pretty good in terms of pass rate for a nature exam of this nature. This is for whether if you have done it before or if you're thinking about it. It's a new industry, new products all the time, and a lot of times different buy or sell side look at different products, very similar in structure but different names, small things being different to suit the buyer. So knowing the CAIA curriculum will help you understand all these products in a much more meaningful way. In terms for us, we have Mavis that will describe later on what we offer, but if we look at in general, what we have is you have pretty limited time to go through all the material. It's not a lot, but inside there are more important material than the others. The formula and calculation, sometimes it might be skipped over pretty quickly. So if you come to class here, we have a much faster learning curve. So you can spend one day and learn the whole module rather than spending 3 months reading over, recalculating and checking and understanding what is going on and what they're trying to test you on. So here it's more effective in terms of what you learn, how you absorb, and more efficient in terms of your time. You get the same learning outcome with a much shorter time. In addition, especially for level 2, if you look at the new materials being added, for example, family office, the sovereign wealth funds, they've added endowment and foundation, which was discussed very, very briefly before. For these, they've added quite a bit of stuff. They look at how they invest, their approach, the risks they face, which were all brand new. So for example, in the family office, they've added several new topics, including which generation it is. So first generation family office, the guy that worked hard and get rich, he started family office. So at that stage, the specific requirements and goals that he has, if it's second, third generation, so his son and his grandkids might have different perspective and different goal in their investment in the family office. So it goes into pretty much in depth in what goals they have, what strategies to do, and what risks they face for even different generations of family office beneficiaries. So these are all new for level 2, not covered in level 1. So this is on the calculation question, mechanical type versus easy but theoretical. This is one example of private equity fees. So it's covered in level 1 as well, but more detail in level 2. For private equity, you are committed for 7 to 10 years. So it's a pretty long commitment. You cannot get your money out pretty easily. So to protect the investor, they would put in many different fee structure to protect their return and their money back and performance. So these are all the various fees that apply in an actual private equity transaction. So you would normally hear about the 2% management fee on committed amount, not even when not drawn down. You will have performance fee. So 20% will be the 220 normally described for AI. However, because of the long commitment period, there will be a hurdle rate, which are rate paid to the investor first before the manager get the carry interest. So there are different ways to calculate that. There's also a performance fee waterfall, which has to be calculated as well. So all those will affect the level 2 questions. There's clawback provision as well. So the fees might be put into a temporary escrow account. The manager cannot withdraw until near the end when the return has been verified. There's also transaction fees. So this is more specific for LBOs. When they invest in portfolio companies, then they do transactions. They charge fee on the portfolio companies as well. So, but eventually, it belongs to the investor because it reduced the value of the investment of these LBOs. So these are the mechanical type calculation. You know how it's calculated. You do it properly step by step. You get the right answer for sure. The other types are more theoretical. So these are examples of things you have done. For example, using binomial tree to value convertible bonds and how they're hedged. So they might ask a very simple but theoretical question on how that is being done. Or for CDS, which partially covered in module 1, but more in level 2 would be you check the default probability of someone claiming default for CDS. So we'll use the bond pricing to back that out. It can be asked in a more theoretical perspective as well. So these are the two types of quant questions they can ask in both level 1 and 2. So this is the basic outline. We'll do a quick demo lecture. I try to get material here from both level 1 and 2, so it's pretty broad-based. Many of the things talked here appeared in level 1, but they are in more depth in level 2. But I try to go through example questions so that many of these can be backed out with just common sense after you read the material. So it's not as difficult and as hard as it seems when you look at the textbook itself. So this is on credit risk. This is more specifically for CDOs or credit default swaps. So for CDS, someone come and buy health insurance, but it's to protect default of a bond. So similar to health insurance, you tell them what you want to buy to protect. They quote you a price for the protection. So this is similar. A bond fund manager owns a portfolio of different bonds. He's afraid someone part of the bond might default and he might lose money from that. That affects his return. So he called up his bank and asked, I want to buy a CDS for this particular bond. Tell me how much. The investment bank will call back and say, well, what protection level do you want? Similar to when you buy health insurance, do you want serious illness or just plain every visit coverage? So these are the different coverage level for bond defaulting. Some you don't really buy. So for example, for the third one, it's just a credit spread risk, meaning even if the bond and the company have no movement, nothing new happens, the credit market moves around even every day. So this just a risk of the bond price move because of other external factors. This one seldom it's being purchased because it might cost quite a bit for just basic protection like this. Someone might buy a downgrade risk protection. So if a firm is having a AA rating before the purchase, the holder of the bond is afraid there might be a downgrade coming. Bond price will go down. He wants the protection, so he might buy a downgrade CDS or pure default. If the bond cannot be repaid, then there's protection that cover that part. So this is the level of coverage you can buy for the CDS, which the seller of the protection will have to get the risk level of getting that payment for the default or the downgrade. For the model they use, so now I'm the investment bank. I need to quote a price for the bond fund manager to have its coverage. There's two models that can be used. One is structural model. Normally they do the full cash flow of the asset. So they would check the company's cash flow and see the chance of default and use that. Can also use reduced form model. Reduced form is like your option pricing, where they check the bond price and back out the chance of default based on that because of the credit risk built into under the bond price. Here for the structural model, they also use a option-based model. So we'll look at one example in a bit, but we won't be doing that because you need the book to answer it fully. So it can be done both ways. For the reduced form, we have 2 or 3 formulas to remember, but otherwise it's pretty straightforward. You're given the price of the bond and you back out the chance of default from that. In terms of example for the calculation, or not calculation but a logical common sense way to answer these questions, this is something from a real estate or real asset session. So this is on real assets but not calculation. So here it's just simply asking if I'm the investor of a real estate investment. So for example, I bought a shopping mall. And then I sign up lease with the tenant for 10 or 5 years. If any of these things happens, which one I would most likely benefit from these? So here, a good way to try to get the right answer is do it logically as if you're the actual owner of the shopping mall. So here, the property with a long lease term. So here I sign lease for 10 years with my tenants. And normally the lease would have price or lease rate adjustment clause. So I might have a 2 or 3% increase on the lease rate per year or based on CPI, but normally a range is given. So here, if I have a inflation that is unexpected, so here they would mean I have a 3% adjustment available every year, but inflation, let's say, is 20% for year 4. Then in this case, it cannot benefit me because I'm receiving rent income, but the inflation rate is much higher. My lease rate adjustment from inflation cannot catch up. So if I have a long lease, it will probably not benefit me. It might actually hurt me with high inflation. That's unexpected. So it should not be A. For B, this is part A is on revenue side. So you can look at, think of the rationale the same way with part B, where when I buy the shopping mall, I borrow money. For part selection B, I'm using adjustable rate mortgage. So here, adjustable rate mortgage would mean every year or two, the actual interest rate I pay is adjusted to the market level plus the spread. So here, if inflation go up, my loan rate will also go up as well, which follows the inflation. So here it probably will not benefit me because if I combine A and B as one set, my income doesn't follow the inflation that go up. On the other hand, my cost for the loan, which are interest costs, do go up. So A and B cannot benefit me if I'm the owner and high inflation unexpectedly. For C, I have a fixed rate loan, so compared to B, it will be a beneficial situation for me. I have a fixed rate loan, so if inflation go up, floating rate or market rate go up, but I'm locked into a fixed rate, so I'm actually in a better position because I locked in a lower fixed rate loan than would have if I have a floating rate or a new fixed rate. So C should be the right answer, purely from logically deducting what happens, what if the rate go up, right? So this will be an example of how some questions can be easily figured out based on just a situational analysis. This is the second question we'll do. This applies to property as well. If you look through the level 1 and 2 asset class, we have the 4. We have the real asset, which includes real estate. We have private equity. We have hedge funds and structured products. For private equity and real estate, for these two in particular, you have a problem with your valuation. So because for these two, you cannot actually get a transactable market price at year-end if I want to mark to market. Because real estate, all you can get is an appraisal. For your private equity, you have an NAV. So the manager is investing in several startup companies in China. If you ask them at year-end, what's the value, all they give you as an estimated NAV, they would not know what it's worth if I actually sell the company right now. So whenever you have these appraised value or NAV estimated value, you have a smoothing effect, meaning the price is not actually market, and the price quote to you might be smoothed over time, not the actual market price. So in level 2, level 1 talk about smoothing, what it is. In level 2, you have to calculate how to unsmooth it, because I want the return of the manager. If he give me a smoothed price, then his return is also smooth, but I want an actual one. So level 2, the focus is on unsmoothing the return that I'm quoted. So if I get an unsmoothed price, I can get an actual return of the manager that is more representative of his performance. So level 2 is unsmoothing. Several formulas were being taught in level 2 on unsmoothing different private equity or valuation. This is normally a smoothing factor. So in this case, if we look at the question, it says, oh, I need a true price change, but For the property, I only have an estimated price change of 20 to 32, I would assume it's million, right? So price go up by 12 million here. This smoothing factor means for the actual price change for the year, only 0.6 is being smoothed into the price. So 0.6 of the true price change is built into the smoothed price quote to me from 20 to 32 million. The other 0.4 is actually lagged or from previous time period. So I need to estimate what the actual true price change is for my return calculation. So here, I want to point out, you don't need calculations nor anything, because if you think about the true price change, 60% got built into this 12 million increase. So the true price change must be more than 12 of the increase because only 0.6 got put in. So if we look at the potential answers, we have A, B, and D, which are unlikely or impossible answers. If my price change is anything less than 12, like in A, B, and D, I can never observe a 12 million increase in my smooth price. So here, even without calculating, C would be the only possible answer given a 0.6 lag factor. So if we want to calculate, 12 million is the price increase we observe from the smoothed quote appraised price, and 0.6 is the amount of true price change that got put in there. So 12 million is the 0.6 of the true price change. So that means the true price change is 20 in our case. So that would correlate with, if you calculate properly, you get the same answer, but you can just estimate through here because of the scale of the numbers of the true price change. So here just an example of how this can be deducted through logic without actually doing all the calculations. This is the last one we'll do. It's similar in a way. We go through, this is on the commodities and the futures trading. So all these can be used for hedging purpose. So when we come to a part like this, there are trigger points. So as you read the question, we need to make sure we pick up all these, because you missed one, all your answers will be opposite. So here I'm looking for the best way. So it doesn't say whether it's best in terms of cost or effectiveness, but we'll see what they want to do. Next important part is to hedge. So I want to hedge. Here it's a little bit different. For the normal part of CAIA 2, the view is I'm the speculative investor. I want to make money. But here it's hedging, so I want to make sure I pick up what hedging can do with these A, B, C, D choices. So I need to hedge away the risk of, I'm hedging the debt. So debt is a major part, not equity, but debt. So it makes a difference in what I need, what I'll use to hedge. And it's a commodity producer, not a user. So here, I need to hedge a producer of commodities of the debt going default. So if you think about what this guy is doing and what his risks are, so if you do hedging, the first thing you need to figure out is what are the risks before you can decide what to do with the risk, right? So here you need to figure out what the risks are for the commodity producer and for the debt to go into default. So here I'll do the full version. Normally you can do this in your head without actually doing all this, but it'll make the process easier here. So this is a producer. Commodity, we assume these are wheat. So we have a wheat farmer here. He is a farmer in the US, plowing his Caterpillar machine across the field and growing wheat. So after he grow and harvest the wheat, he sells to Kellogg, and Kellogg buys the wheat and make it into Special K, which in turn they sell at supermarkets. So producer is referring to the farmer here, user is the Kellogg. So now we check if I'm the farmer, I have equity and debt from the company, and I want to check what will make me go into default from the farmer's perspective. So if I look at the income statement, also like cost and revenue, I have revenue and cost, and I have net profit or net income. So I want to check what happens if wheat price go up or down, which direction makes me go into bankrupt. So here, when I'm the seller of wheat price is my revenue, right? Wheat price go up, I get higher revenue. Wheat price go down, I have lower revenue. So in this case, my risk is wheat price go down, my revenue go down, do not cover the cost, and so not enough cash to cover my debt, and so I go into default. So the risk for the producer is wheat price going down. That is the risk of the producer. So now I want to figure out what I can do for the hedge to make money when the wheat price go down. So in this case, when the wheat price go down, the farmer suffers. He might go into default, but the hedge that I buy now would help me reduce that because it'll make me money, right? So that is what I'm looking for now. Here, if I put it in here, depends on who it is. If they say the user, which means the Kellogg, it'll be a different situation. For Kellogg, they buy the wheat. So wheat is the cost for Kellogg. Risk is, for Kellogg perspective, the price of wheat go up, right? So it depends on who it is. Here it's the producer, so the farmer. If they ask for the user, then the risk is the wheat price going up because that is Kellogg's cost as input, right? So going back to the farmer's perspective, what I need is A, B, C, D. Find one I can buy or sell or do so that I benefit or make money when wheat price go down. Right? That is what I need to do. If I come down the list, I have 3 based on options and 1 based on futures. So if I look down, at least I try to eliminate impossible or not likely choices first. So here, A would be unlikely because normally when you sell options, you lost the right to choose. So for hedging purpose, selling option normally cannot work, right? Because what I want is I buy the option. When I need protection, I use the option. If I sold the option, then it can only be worse for me. It cannot help me in any situation. So this cannot be correct in the first place. Next is I check the 2 options. One is I buy. So buy is okay, properly in this case. One is call, one is put. So I want to check. I want an option that make me money when wheat price go down, right? So price go down, I make money. So here, if I buy a call makes me money when the price go up, not down. So B cannot be correct as well. B would be good for the user like Kellogg to buy to hedge their risk, but not for the farmer, right? So now they ask for the producer, B is out as well. So buy commodity put option. So this would be a correct choice. I buy the put option, wheat price go down, potentially the debt of the producer might go down in price even without default, right? So here I buy the put option on wheat. I make money when wheat price go down. It offsets the producer's bond price going down. So this is a potential option. When I look at the last, selling commodity futures can also work as well, right? Because when I sell futures, wheat price on wheat futures go down in price, I make money as well. So C and D both can work. So now I got to figure out which one is better because it's asking for the best way. So now when I look at the 2, this is the payoff diagram. For a put option, if I long put, my payoff look like this, right? Price go down, I make money. If I sell or short futures on wheat, my payoff look like this. It's pure a -1 slope line. So when I want to see which one suits me better, I want to check what is the debt profile if I'm the owner of the bonds. So when I look at the bonds, what I have is a shape like so. Right, when the producer has no problem, I have my interest payment because it's a bond. It's fixed no matter what happens. So I have my interest payment here. when the producer is okay. When they are in trouble, then my bond price go lower and lower. Eventually, if they go bankrupt, the firm is mine. So my bond payoff is like this. If I look at what I can buy C or D to offset the shape, only C will work, right? Because if I combine the two, I have a flat line. So in this case, if the wheat price go up towards the right, my option will be expired, not used. I have no loss. On the other hand, if I use the futures and I short the futures, my bond is like this. If I combine a future with my bond. So how can I get protection? Same with the options. When the wheat price go down, on the left side it's okay. They both offset, so I'm hedged in that case. But if I use futures, I have a problem with wheat price go up. Right? Wheat price go up, I still earn the same interest on the bond. I'm not getting more. However, if I short futures and wheat price go up, I actually have a loss on the futures, which is not covered with my income from the interest. So here I'm actually not hedged well because I'll be exposed to wheat price going up and lose money there using futures. So here's still the only correct option to use for the debt of the producer. If they ask for hedging the risk of the producer's equity, then futures potentially might be a good one to use. Okay, so here the correct answer is C here. Just looking at what is being covered for the risk, how to hedge it. We have two more questions here, but we're not going to go through. Here it's trying to look at, if we look at earlier, we flip a few slides back, we have the structural model to evaluate credit risk. We have option-based model being used. Two is being covered in the curriculum. One is Black-Scholes version, other is Merton's version. So they have very similar structure, just use different options to do the valuation. So here, it's a little bit detail on how they would ask. So it's looking at how do I value convertible bonds using Black-Scholes option. The other is Merton. So trying to see if you can understand what does the Black-Scholes model use as the underlying assumption versus the Merton model. This is on asset allocation. So before it's in level 1 in the last topic. Right now they have some in level 1, but they move a little bit of it to level 2. This is on if I allocate my money using risk instead of my return to risk, right? So normally when you allocate money for your investment, you use return to risk, highest return to risk like Sharpe or Trenner ratio, and I allocate that way to maximize my return. Here they found in research, when I allocate based on risk, so I use the risk level of the investment to allocate my money, I actually get a better return and a lower risk by allocating it this way. So this is covering on how to calculate how much to allocate. So it can be 50%, 40%, 30% of the total based on value at risk calculation. So these are the components that's being calculated to allocate the total portfolio value at risk, how to allocate it to different investments using components of each asset I have, the risk they contribute to the total, and the marginal val. If I buy $1 more of private equity, what additional risk I get, and from this I calculate how do I allocate my money based on the risk. So this is called risk budgeting, where instead of budgeting my money, I budget my allocation based on risk. They cover 3 to 4 different ways to do it. One is called parity, equal risk for all assets. Some might be different way to allocate the risk. So here this is just an example of how they would ask without calculating. So this is more theoretical based. How do I calculate total risk and allocate based on marginal component and how they add up, right? So this is more of the non-calculated type, more qualitative, understanding how this works other than calculation. So here, that is what my part would be. If you have questions on level 1, you can ask Mavis in a bit, but let me bring her in so you can tell you more about the different things we offer. You have any questions for this part? I can talk to you afterwards.